Right. So now, Constantine, the floor is yours. Thank you.
Many thanks, Fernando, and good afternoon to everyone. It is the fifth session of our training, webinar training, and as already Fernando announced, this time we'll discuss cost of capital. People remember who participated the last time, they remember that we discussed issues related to revenue requirements and regulatory asset base, and we said that also for investment, to encourage investments, but also really to ensure proper treatment of capital cost, we have to include the return on assets and also depreciation. And also we said the last time that return on assets depends on two components. One is the regulatory asset base, which was explained the last time, and second one is the allowed rate of return. And exactly today we want to explain more what means allowed rate of return, or sometimes also is called cost of capital, the percentage which the regulator would allow to the regulated businesses to charge in the allowed revenue. What you see now is the table of contents for this webinar session today. We actually want to describe a bit first in the beginning really the concept of cost of capital, especially the weighted average cost of capital, which is widely used in the regulatory regimes across the world, I mean Europe, but also everywhere. And then in the second part of the presentation, we want to focus a bit on the quantification methods, how we really measure in quantitative terms the cost of capital, the equity, especially the equity return. And in this case, we want to describe or explain a couple of models, actually the leading one, which is called capital asset pricing model, but also several models which are well known from the academic literature and sometimes also used in practice. And then just to conclude the session. Starting now with the first point, what is the cost of capital? I mean, we can say in very simple terms that is a measure of the financial return that on one side the investors would seek, because they have to, if they want to invest in the industry, and for the risk would they really accept to invest in the industry. On the other side, of course, it will be the return which a regulator will be prepared to allow, to permit to the investors for their investment in the regulated business. Usually when the regulator decides on this return, there are several important objectives which must be followed. The first one, which actually is the leading one, is really to ensure or to decide on sufficient return, sufficiently high return or rate of return, which will be attractive for the investors to invest in the regulated business. And because regulator is looking also for objective measure, how to really to quantify, to calculate this return, usually we see regulators trying to use capital market-based models. It means just to look for references and also really relationships to the capital markets. Also, the return which the regulators would allow, is important that this return adequately really consider this risk, the risk which is characteristic or specific for the regulated industry. And one additional but very important objective, we also see the regulators usually try to incorporate some incentives for the gearing or for the capital structure in the decisions on their cost of capital, with the general idea to support, to incentivize, to encourage the achievement of optimal capital structure, with other words, actually really minimizing the cost of capital. We'll come to this point related to the optimal capital structure in a separate slide in the next minutes of this presentation, and we explain how really this measures to encourage optimization of capital structure or minimization of cost of capital are really used in the practice. If you see now a general diagram or general picture for the determinants or for the components of cost of capital, it could be simply presented in this way. What you see here in the middle is the so-called WACC. It is really the cost of capital concept, which is called weighted average cost of capital. It is used very widely, almost by all regulators. In Europe, we have sometimes exemptions. For example, German regulator does not use WACC explicitly, but actually in the whole process of really setting the allowed rate of return on equity and debt, they are again probably similar thoughts like the weighted average cost of capital. What you see here is the WACC, and then you see the determinants. What on the left side, you see actually the equity components. We have two elements here. One is the cost of equity, the allowed return on equity, the percentage, and one will be the equity share, the weight of this equity in the total structure of the WACC. And you can see also on the right side, similar thoughts, cost of debt, and again, the debt weight, the debt share. I mean, the simple idea to have equity and debt is because the business, in this case, the regulated business, will be financed by portion of equity and portion of debt. And also, regulator wants to allow exactly this efficient cost of financing. And when we say portion of equity and portion of debt, it is again the case of capital structure or gearing. And regulator wants to see also here really incentives, and that's why it incorporates in many cases already set it in the previous slide, incentives to optimize or to encourage efficient or capital structure or minimal cost of capital. And there is one additional element, is this one, taxation. We mainly refer here to corporate taxes. And in this case, WACC, the concept of WACC, can also incorporate elements of corporate taxes. In this case, depending on the specification of the WACC, taxes could be including on the equity side, for example, with adjustment also called pre-tax WACC. In this case, we'll increase the equity return with taxation multiplier or tax adjustment term, or could be also considered on the debt side if we use post-tax specification of the model. In this case, we'll reduce the cost of debt because of deductibility of the interest and the tax shield. However, we have to really be very careful and in this case ensure proper treatment of the taxes, corporate taxes, in the allowed revenue. We'll come to this point also later in our discussion. What you see here is again the formula, what I explained now in the previous slide. You can see now the mathematical formalization of this WACC model. On the left side, we see the post-tax WACC. This what you see here, the formula is specification of the post-tax WACC model. And as we said, is a cost of equity. It's the really allowed equity return. We'll come to this point later. And cost of debt. And what you can see here is the equity share and the debt share. As already mentioned, it must be not necessarily the actual capital structure which is considered here. Usually, regulators want to see their capital or the allowed capital, optimal capital structure, which could be different from the actual one. And here, on the right side, it's 1 minus t. It's the tax term. In this case, we have WACC post-tax specification of the WACC model. That's why we can see here the deductible effect of the taxes, which in this case will reduce the cost of debt. However, as already said, it is important to include in absolute term the taxes in the revenue requirements, because from the company's perspective, they have to be recovered in the allowed revenue. Last time we discussed the revenue requirements. Today is just really the topic WACC. That's why we don't deal again, we don't go back to the topic revenue requirement. But what is important is to have really always this link in terms of explaining and also looking at the interfaces WACC and also specification of the allowed revenue. Cost of equity, it is the percentage of the equity which is used by the investors or used by the company in the provision of regulated service. And in this case, we can see that it includes two major components. One is the risk-free rate of return. It means the rate of return of securities which are without risk, or we can say here no default, non-reinvestment risk, plus, because we have here normal business, not really business without risk, plus something which is called risk premium. And in this case, we have the risk premium multiplied also by factor beta. We'll come to this point later when we're explaining the capital asset pricing model. In this case, we can say in just in very simple general terms that the risk-free rate of return will be corrected, will be increased by additional term to incorporate also the risk for the specific industry which is regulated in this case. Similarly, we have cost of debt. This is the percentage which the regulator would allow to the debt holders for their capital provided to the regulated company. And again, the logic is something similar. In this case, again, we're starting from the risk-free rate of return, and then we have to adjust this risk-free rate of return with debt premium, or sometimes it's called debt spread, just to incorporate the risk element which is specific for the company like this, using loans or external financing from the banks. Once we have the cost of equity and cost of debt, we have to also incorporate the gearing. That's really the elements of capital structure, which I already explained. And then we have here, in this case, the tax rate. And as already said, in this case, this is a post-tax specification of the WACC model. That's why we have the tax element here on the right side. If you would have had pre-tax WACC specification, the taxation term will disappear from this place and will appear here as a new taxation multiplier. It will be multiplied by 1 divided by 1 minus t. And in this case, the cost of equity will increase because it will incorporate automatically the tax effect. So regulator would allow higher WACC and higher return on equity just to include also the taxation, the corporate tax, which must be paid by the company to the government and financial authorities according to the tax legislation. Starting with the cost of debt, we already explained that the major logic is to have a risk-free rate of return and also that risk premium on the top of this risk-free rate of return. If possible, regulators in any case would try to use market data. That's why the availability of market data will be essential to calculate the cost of debt. And as already said in the previous on the previous slide, the risk-free rate of return is the return on an asset which bears no risk at all. So we don't have any default risk here. And from this theoretical definition, we go to the practical application. And this is usually using long-term government bond and their yield just to measure really the risk-free rate of return. And in addition to the risk-free rate of return, we said that it is important to incorporate or to set the so-called debt risk premium. So it means it will be something which the regulator would allow on the top of the risk-free rate of return. And in this case, we're looking really to measure this debt risk premium. We're looking at corporate bonds which have similar, corporate bonds for companies with similar business and similar risk structure, and really the yield on these corporate bonds and the difference between this yield and also the risk-free rate of return would really allow us to measure, as a regulator, to measure the debt risk premium. Sometimes, or in many cases, regulators also looked also the publication of credit ratings institutions, and in these cases, just they try to measure the debt risk premium based on this publication and based on these ratings published by these institutions. In the case of cost of equity is similar, however, with some differences and probably a bit more complicated approach. Also, in these cases, we're looking risk-free rate of return and premium on the top of this risk-free rate of return. Also, in this case, we're looking at market data and reference to capital markets. The availability of this data is essential to calculate the cost of equity. And the same, like in the case of debt, the same thoughts apply here for the calculation of risk-free rate of return. What is a bit different here, and it depends on the model, is how this premium is established. And this additional premium includes, in the general specification, the so-called capital asking pricing model, includes really two components. One is the so-called equity risk premium. We'll come to this one later. And one is the beta coefficient, which actually really would adjust the equity risk premium. In very simple terms, the equity risk premium measure the difference of the market return and risk-free rate of return. And the beta coefficient will try really to measure the correlation between the return on the market portfolio and on the individual assets. In this case, for example, the shares of the company which we investigate. We can see that automatically in this case, the beta, it is really important if you want to have the direct estimation. It is important to have a capital market really data. So the company which we investigate should be listed on the capital markets, just to allow to establish this correlation links, or to calculate the correlation between the shares of the investigated company, the return on the shares, and the market portfolio return. If there is no really public trade, or that this company is not really publicly traded, in this case, we have to look really for any kind of additional methods and additional estimation of the equity beta, usually, for example, using large samples from other companies which are comparable from other countries, also large international samples, which could be used just to really approximate, to estimate beta equity for the company which we investigate. The process actually is long. It's difficult to describe this process in a couple of steps here in this presentation, but I'll be happy to answer questions if they appear after this presentation. To this point, how to use international data to estimate equity return for specific companies in a country where there is no really capital market, or there is no, actually there could be capital market, but there is no really listing or publicly traded shares of the investigated company. What you can see is a table which summarizes recent decisions of different regulators in Europe mainly, but also you can see Australia in this case for electricity, but also gas, for the so-called equity risk premium. Again, just to remind you, equity risk premium is defined as the market portfolio return minus risk-free rate of return. And what you can see here is really the ranges which these different regulatory authorities have discussed in the consultation process, min-max, in different countries, and also their decisions in at least the last regulatory determination. It was till 2006, the data what we studied. It is not actually in the last 2 years. Probably some of these numbers could have been revised if regulators have done any new price reviews and resetting of the allowed parameters for the next price control period. It is important to say that many of the regulators in these cases, they have also referred to large international studies in the decision for the market risk premium, of the equity risk premium, and used also large international database. One very well-known large international database is the DMS database, which actually is abbreviation of the names of 3 American academics, Dimson, Marsh, and Staunton. This actually is widely used database, which is really extremely large. It includes many years, also from many countries in the world, and provides also rather good basis for discussion, but also calculation of equity risk premium. Capital structure. Again, this is the one of the most important also component of weighted average cost of capital. We discussed now cost of equity and cost of debt, and we said also that to calculate the weighted average cost of capital, it is necessary to weight cost of equity and cost of debt. And this weighting, so the shares which regulator would use to calculate the weighted average cost of capital, is based actually on this assumed gearing or allowed capital structure. And we said also at the beginning that regulator can decide not to use the actual capital structure, but to use target capital structure or really regulatory capital structure for the purposes of setting the weighted average cost of capital. The reason of that is that regulator wants, as already said, to use an optimal capital structure to set incentives to the companies to work with optimal capital structure. It means to minimize the cost of capital. And now when we say optimal capital structure, it is really the next question, what does it mean? What does it mean optimal capital structure? Optimal in terms of what? We said already that actually the optimization is really looked in the context of minimization of the allowed cost of capital. It means the optimal capital structure will be this one, which will minimize the weighted average cost of capital. Looking now at this graph, we can see exactly what is going on and why we're talking about this minimization on one side and also optimal capital structure on the other side. It is known from the theory of corporate finance that the equity return is more expensive, or cost of equity is more expensive than the cost of debt. That's what you can see here is the two curves. One is higher cost of equity than the cost of debt. In this case, one can say that if we start increasing the debt share, the cost of capital weighted, it means the weighted average cost of capital, will start decreasing. That's what we can see here in this trend. So more debt, which is cheaper, and then lower value of the weighted average cost of capital. In this case, we continue to extreme. One can say, why don't we use only 100% debt? This will really absolutely minimize the cost of capital. Yeah, it is probably good thought, but doesn't work in the practice, because at certain level, with the increase of the share of the debt, the degree of risk or the risk perception for this company, first by the equity investors and then second of the debt holders, will start increasing. So the companies or the investors will perceive this company as more and more risky, and they will increase their demand and requirements to the return. So the expected rate of return on equity and on debt will start increasing. And the effect, first the effect of the cheap debt, which was at the beginning prevailing, would really start slowly disappear. So we'll have actually so to say two effects. One is the effect of first the cheap debt. That's why we have the incentives to increase the debt share. But to a certain point, because beyond this point, the cost of equity and also debt will start increasing. Now we're looking for this exactly, to say, optimal point, which really incorporates the two effects and minimizes the cost of capital. What you can see in the practice, based probably on this theoretical consideration, is the capital structure or the gearing which is used and allowed by the regulators is 40 to 50. When we say 40 to 50, it means 40% equity. In the first case, 60% debt, or 50-50, it means 50% equity and 50% debt. Especially 40-60 is very widely used in Europe. For example, we can see UK regulators using similar numbers, the Netherlands, Dutch regulator, Austrian regulator. In Germany, we have also 40-60. Even there is no explicit WACC. We have again a lot of, in many cases, the equity return and also the whole consideration used in Germany to set the cost of capital based on the, again, 40% really allowed maximum return, maximum number of equity in the regulatory determinations. And the last point is treatment taxes. I already explained. We have two general, really general models. One is the so-called pre-tax return. In this case, the equity return will be increased to incorporate the corporate tax, and the corporate tax will be not included in the allowed revenue as explicit revenue item. Or the second model, it is the so-called post-tax. In this case, the taxes will be considered on the debt side, so we have a deductibility effect. So the debt return, the return on debt will be decreased. However, the taxes will be included, the corporate taxes will be included in the allowed revenue as an explicit item, and will increase in this case the allowed revenue. So post-tax model, taxes are not included in the weighted average cost of capital, but in the revenue requirements. Pre-tax model, pre-tax WACC model, the taxes are included in the weighted average cost of capital. They increase the return on equity, but not included in the revenue requirements. There is a model in between, which is called vanilla WACC. In this case, corporate tax is not considered at all in the determination of weighted average cost of capital. And it is first actually similar thoughts apply like the post-tax WACC, in the case of vanilla WACC, there is a difference how we have to incorporate really in the allowed revenue the taxation elements using the full tax shield or just actually partial one. Again, I'll be happy to answer questions here. It is a topic which goes beyond the scope of this lecture. And it was again the first complete part. Now we'll move to second one, the quantification of cost of capital. Shortly for the first part, again, we explained the weighted average cost of capital and the determinants, cost of equity, cost of debt, capital structure, taxes. Now we move to the next one, which is really these quantification models. And we want really to discuss a bit more which are these quantitative techniques, which are really well known from the theoretical literature, but also used in practice to quantify, to determine the level of cost of capital. We can see here in this diagram 6 models. Actually, the first 4 models are more really quantitative. It means the mathematical background is strongly expressed. Actually, they are strongly dominated by mathematics. And the last 2 a bit more softer models because they are just related to specific either historic performance of the companies, so numbers, or really regulatory decisions from the past in the country or in other countries. We're starting with the capital asset pricing model, which is really the dominant one in this case, and it is used almost by all regulatory authorities, and not only actually by regulatory authorities, it is very strongly used also in the corporate finance departments of the companies for their decisions on hurdle rates or expected rate of return in the investment analysis, financial analysis. So it's a very popular model. What we have to say, actually we start already explaining in the previous session the concept of capital asset pricing model when we explain the return on equity or the cost of equity. And we said that the cost of equity includes 2 major components. One is the risk-free and one is the additional premium, which actually is defined as a equity risk premium and also one multiplier called beta. What is important is that the capital asset pricing model measures only the systematic risk. So it means this is the risk which is common for all assets in the market. Sometimes you can see that so-called market risk, and this is the risk for being in the market, and this is a risk which cannot be diversified, so it cannot be eliminated or reduced by diversification, as opposed to other company-specific or unsystematic risk. So CAPM just looks at the systematic risk and really aims or tries to quantify this systematic risk, which means that the stock owners are just compensated just for this systematic risk. What you can see is the specification or mathematical definition of the CAPM model. On the left side is the expected rate of return on an individual capital asset, could be a share in this case, and as already discussed, it is composed by one component, risk-free rate of return, and by second multiplier, this is the whole this element here, from here to here, which is this additional premium, including market, or sometimes as it's already said, called equity risk premium, and the beta coefficient. This market risk premium, as explained, is the difference between the market portfolio return and the risk-free rate of return. And in addition, we have the beta coefficient, which would measure correlation between the market portfolio return and also the return of the individual investigated asset. What you can see here is an error term. If we just, in a typical regression, we always define this error term for factors which cannot not incorporated in this equation, and factors which actually, and in this case, these factors will, because they omitted in the equation, there will be a difference between the value in the regression, it means the fitted value, and the actual observation. Like any equation, if we, let's say, try to measure in econometric terms the dependence, the relationships, we will see this regression, we will see exactly the fitted value on the line, which is really the regression line, and we see also the observations, the real observation, actual observations. This again, error term is the residual, it means the difference between the actual observation and the fitted value on the regression line. The line below actually is really transformation of the previous equation. In this case, we have on the left side, just we moved risk-free rate of return to the left side. We get a new left side, which is the difference between the expected return and the risk-free rate of return. And on the other side, again, we keep the risk or the equity risk or market premium and the beta coefficient. Now, if we move to the graphical representation, we can also represent the CAPM model with the so-called security market line, which would describe a relation, the relationship between the beta on one side, in this case, the horizontal axis, and also the expected rate of return, which is on the vertical axis. And because you remember from the previous slide, this is a linear regression, we can say that there is an intercept which is equal to the risk-free rate of return, which was the first coefficient in the regression equation, that's here. And also there is a slope, and then we can see also the increasing security market line with the increasing beta. In this case, beta is a measure of the systematic risk. There will be a point where beta is 1. In this case, the expected rate return is exactly equal to the whole market return. And we can see also some areas below this beta 1 or above beta 1. In the cases when beta is equal to 1, we say that we have equal, that the portfolio, the individual portfolio is equal to the market portfolio. So we have actually a correlation which is equal to 1. And then if we go below than 1, we have low risk assets because the correlation is less than 1, the correlation between individual asset or individual asset portfolio and the market portfolio. Similarly, if we have really assets with beta more than 1, so it will be on the right side of the this point, so in the higher, on the upper area of the security market line. In this case, we'll have a relatively risky assets because actually they will be fluctuating with stronger than the fluctuation of the market portfolio. So in this case, we're talking about relatively risky assets or the higher risk premium. Now we go to the so-called Fama-French three-factor model. Again, in the first case, you remember the CAPM explains the return of the individual asset using just one major really explanation factor. This is the equity risk premium, which is defined as a market return minus risk-free rate of return. The model of Fama-French goes a bit further and introduces two additional explanation factors. So you can see that we're getting the multiple regression with a couple of components, not only with one. So instead of having only beta, like in the previous case of CAPM, we have gamma and delta. So these are two additional coefficients. And they also attach to two additional variables, SMB, which means small minus big, and HML, which means high minus low. The first really additional component tries to measure, actually is based on the idea that also the size of the company can have an impact. And the second one is also introduces with this HML component, introduces the value of the companies. What actually is going on? We're trying to introduce additional sample of points, or additional group of points, explanatory points, which are based on differences of perceived small and big companies in the whole market portfolio. So we have to really discretionarily split the market portfolio into groups, small and big, based on market capitalization, for example, and create the differences between the average returns for small and for the bigger group. These differences will give us additional measurement. It will be one additional point. And if we have one additional point in time, so we have many periods of time when we measure, so we have a group of points which will be used also to specify the whole regression. Similar ideas apply to the H minus low book to market. In this case, again, we split the market portfolio in two groups. One which is actually book to market low and one is book to market high values, and create additional group of points which will again support the explanation of the expected return of an individual asset. So in this case, as already said, the regression line is getting bigger and we're getting additional observations and just trying to explain better the expected return. Just to summarize now, is in the Fama French we have also the classical case of the market risk and the beta coefficient. In this case, as explained before, beta equal to 1. Beta, as you remember, measures the really correlation between the market portfolio return and the individual assets. If beta is equal to 1, we have actually really parallel moving if market is moving. So exactly the same is relevant for the asset portfolio, which we investigate. And then if beta is less than 1, we have actually less risk because the fluctuations of the market, the individual portfolio, are less than this in the market portfolio. If beta is higher than 1, we have the opposite effect. We have higher risk because the fluctuation of the returns on the assets of the individual portfolio will be really higher than those on the market. With the two additional factors in the Fama French model, the size and the value factors, what we explained in the previous slide, we're introducing also a bit additional effort to explain the behavior and to explain also the expected rate of return. The idea is that size measured via the market capitalization and value measured with the book to market values can have really a role here. And we're talking about premiums. It means size premium and value premium. What is interesting that we're talking about empirical observation and also less theoretical foundation. And these empirical observations based on economic analysis and econometric analysis, actually in this case, just try to, or let's say aim or state that investments or in companies with small market capitalization can have a potential and also chance for high rate of return. The same is also investments in companies with first relative low market value and high book to market ratio. They can also have a chance for potential premium. That's why in mathematical terms we say that gamma is close to 0 for large capitalization portfolio and close to 1 for small capitalization portfolio. Similarly, we have delta close to 1 for portfolio with low book to market ratio and delta close to 1 for portfolio with high book to market ratio. Arbitrage pricing theory is again a multi-factor model. Similar to Fama-French, it introduces additional variables aiming to explain the expected rate of return of an individual asset. Differently here from Fama-French, it is based more on additional macroeconomic indicators like economic growth, interest rates, inflation, fuel prices, could be also consumer spending and other. The idea of this model is really just to try with more than one variable, more than with the risk-free rate of return, to explain again better the expected return on individual capital assets. The question actually, which is usually put to this model, is which are the factors and how to weigh these factors in the specification of the regression equation. And what you can see in the regulatory practice is that this model is really not used in the daily regulatory life. Also, Fama-French, up to now the previous one, has found limited application, and there are a couple of probably ideas or experiments, but not really wide application of the Fama-French model until now. The fourth model is the so-called dividend growth model. This is a model which is coming from the classical theory of pricing of shares. What you can see in the equation actually is really transformed, modified equation of the pricing or explanation of pricing of shares. In this case, instead of, let's say, trying to define or to determine the price of a share using the dividend yields and the growth, we just modify the equation and we just try to establish what will be the percentage return which a share would give us when we know that the dividend is in period 1 is at this level and the price of the share which we observe at period 0 is at this level. In addition, of course, we have to incorporate the possible growth effect if really the rate of growth of dividend, which is in this case also put in this equation. In this case, it's obvious that if we use the dividend growth model, or dividend discount model, in this case we have to have a reliable information from the capital market, which would allow us, based on the dividend observation or dividend expectations, so the forecast dividends and the observed share price of the shares, plus also the rate of the growth of dividend, which again should be really forecasted parameter, we can determine the cost of equity. In a classical specification, in this case, what you see is the so-called one-stage dividend growth model. We have to assume a constant rate of dividend growth. So it means the rate cannot be different in the second year. It is also possible, and sometimes it's used in the practice, to use two-stage specification of the dividend growth model. In this case, if we're using two-stage specification, this model would allow us to use different growth rate of the dividend for the second stage. So it will be one for the first and one for the second, which could be used, for example, in terms of short-term one rate and also in longer-term different rates of the dividend growth, just to, let's say, approximate better, or to, let's say, reflect better the economic reality and to improve the adequacy of the result. Dividend growth model is usually used by some regulators, not too many, but used by some regulators. For example, in UK, it was used in some price reviews as a second control model to support the results, or to, let's say, verify the result, to cross-check the results which are achieved by the major model. And when we say major model, it is usually CAPM. So again, this results are cross-checked by the dividend growth model, and also it is very widely used in North America and the States, where the capital market data is more granular, and also there is a high availability of capital market data, plus also higher really historic time series as compared as opposed to Europe. Comparable earnings model, it is model which is based mainly on the historic data of the investigated company or industry or group of the investigated group to which the investigated company can belong. So it means specific industry. In this case, what the regulators would do is just really looking at the average historic actual return which has been achieved by the company over a predetermined historic period. Of course, because we're looking not really on any regulatory statement or regulatory documents, we're just looking on the financial accounting, or the, let's say, usually profit and loss account. The data, what we see, and the performance, what we investigate and what we observe, is usually strongly influenced, affected by the accounting policy of the company, of the group of companies which investigated. That's number one. And second, also, we have to say that we have to find first comparable company or comparable sample of companies, and also appropriate period to go for this historic analysis. Last but not least, it's important to mention that the observed returns or the observed profits in this case, just really that's what has been achieved by the companies, and probably it includes also any inefficiency or efficiency or good and bad managerial efforts to, let's say, achieve this performance. It does not necessarily say what the company should achieve or could achieve, but actually it's really just what has been practically done. So the application of this really comparable earnings could again support the major quantification model, and it's also used just kind of, let's say, cross-check, but not really as any leading instrument to establish the allowed rate of return. And finally, it is the so-called regulatory precedence. So it is sometimes voluntary and involuntary use by regulatory authorities, because almost in all cases they or their consultants will look at other regulatory decisions. When we say here regulatory precedents, we usually refer to previous regulatory decisions in the country or in other countries, in similar cases, in similar industries. And in this case, actually, it represents a orientation guiding the regulatory authority to, let's say, or helping regulatory authorities in the way that they can see the decision-making process, the argumentation lines, and also the numbers which have been decided by other regulatory authorities in the region or in the world. We have to be aware, of course, because it's what we see the facts, and these facts may also be based on really different realities. So that's why when we just used, or regulators used, regulatory precedents, it means previous decisions by other regulatory authorities, they have to be aware also on the details of the regulatory regime in the country, and also sector specifics. That's very important. For example, details on the industry structure, but also very important again the political social environment, which has been really characteristic for the countries which where the regulatory decisions have been made. So just it's really important to understand these factors, the details on the regulatory regime, the sector specifics, and also this political social environment, to avoid really any mistakes in terms of comparability and just automatic transfer of the results from one to another country. And also one additional point, which is actually rather important, sometimes also if there is an inaccuracy of these previous regulatory decisions, then can be easily transferred to the new country if the regulator, which has to make a decision now, does not really check and try to understand. So it means it is really important also just to check for the accuracy, in addition to the environment, regulatory, political, social, and sector environment, also to check whether really the decisions or the logic which has been, the underlying logic is also kind of, let's say, consistent and also solid enough if we want just to use these previous regulatory decisions. And this is the last slide of the presentation. Again, I want to summarize shortly before we start the questions and answer sessions. We had a topic today on the cost of capital. We split the topic in two big blocks. One, the first is really what is cost of capital in the regulatory context, and we discussed the concept of weighted average cost of capital, WACC, which is widely used in the regulatory practice. We described also the role of equity and the role of debt. We said also that it's important to understand the cost of equity, how the cost of equity and cost of debt is determined. Also the capital structure and gearing, how the regulator really deals with the gearing and capital structure, trying to set incentives to optimize the capital structure and minimize cost of capital, and the role of corporate taxes and their interfaces with the weighted average cost of capital, discussing and explaining post-tax and pre-tax, but also vanilla WACC models, and there, as already said, implications on the revenue requirements. And then in the second part of the presentation, we explain different models to quantify the cost of capital, starting with the most popular one, which is called Capital Asset Pricing Model, CAPM, then describing also the three-factor from a French model, shortly describing the price arbitrage model, and then dividend growth model, plus also two more soft models, which are not based really on, let's say, such explicit mathematical techniques. The first one is comparable earnings, and the last one is the regulatory precedence. In just last sentence for this presentation, it is again important to see the role of the cost of capital, because with the cost of capital, the allowed rate of return, we just really create, or calculate the allowed return on assets. And as discussed the last time, with the allowed return on assets, and in this case also the cost of capital, a regulator can steer also and encourage a lot the companies to invest. So really, decision on cost of capital are fundamental to establish consistent but also credible environment for investments in the regulated business. Many thanks.
Okay. So I will send my question. So can you illustrate which are typically the elements of risk of an investment? As you pointed out in previous slides, there is a base, let's say, a risk-free activity. Then why, let's say, a transmission system operator or a network activity would involve risk? Which kind of risks are these? Thank you.
Yeah, just probably try to list a couple of, let's say, risks which are normal, I would say. We have an operating risk, or business risk sometimes called, is any activities, because we have to have the construction process, we have to have also operating process in any activity, any industry activity. We have really this operating or business risk, which is specific to a specific industry. We can have a financial risk, which will depend on financial leverage and how really the company's finances would work, the whole financing, usually long-term financing and the financial leverage which is used to finance the company's activity. We can have also regulatory risk, which is a very interesting also phenomena, which is more or less driven by the decision of the regulator, depending how the regulator is treating, in this case, cost of capital, but also investment activities, how the regulator would allow operating maintenance cost, how the revenue would be reset, how really the difference between allowed and really practically achieved returns can be treated. So all these elements, there are many of them really relevant for the regulatory risk. So we can have also additional component which is called political risk.
Thank you very much.
In this case, really, it's related to
a question
any specifics of the political
Monica,
environment and the legislation in the country.
The
so all these components probably can have a longer list.
Somewhere
really would establish
quite similar to mine,
risk, which
but
is specific
seen
and
from the investor,
relevant
so the
for the
bank or the
any specific industry activity.
body.
In this case, the regulated
so
activity.
If you were to identify a metric or indicator for investor risk, what would it be? What? WACC directly? Thank you.
Not really, probably, because what you see also, at least in our work, I mean, the investors, they'll have probably 10 pages, really, tables with really how they measure risk, which in many cases is practically pretty qualitative. So in terms of really starting to investigate the legislation in the country, in any front, from environmental to really to legislation to really to detailed regulation, and goes also really with specific construction of activities in the country, for example, also with availability of labor forces, with and many other factors when they really want to go to invest. So the table will be really long one. To the point of WACC, yeah, there is a role, because what I think what will happen is that at the end, when they have investigated the different risk, yeah, and there is this big table and the reports what they have done, they want to determine one threshold rate or expected return, for example, in this case WACC, which will be relevant for them or sufficient for them for their investment in the specific country. And at the end, of course, with this
thank you,
threshold rate of
so we will
return
proceed
or
to the last
required
question.
rate of return, they will
It's
really just
coming
will
from
go
Pablo.
and just try
He's
to
wondering
do their financial models.
what's
So the investments will
what
be measured
exactly
again
gearing
using
means.
this discounting
Thank
factor,
you.
this really threshold rate of return, which usually will be based on the WACC. Could be also return on equity in this case. Depends how they really calculate, how they calibrate their financial models. Yeah, I mean, sometimes different interpretation. We can say, I mean, different definitions. Sometimes we can say the share of the debt in the total capital structure. It's one definition. So it means the share of debt. If, for example, we can say that the company has 40% equity and 60%
we will adjourn
debt,
now the
that's the share of
session.
debt.
Thank you very much
Sometimes there is a
for attending
definition
this
which
webinar.
is debt divided by
we are
equity.
really
Could be also
learning
this one.
something and
But
improving
let's
our
say in simple
knowledge
terms,
on
we can say in this case, when we say
how
gearing,
the
is the
regulated
measure
activities,
of the
the regulated
share
assets
of the debt in the capital
electricity
structure.
system are organized. So thank you very much, Konstantin. If you want to add some final words, thank you, and see you now in January for the next session. Have nice holidays.
Also on my side, in the side of our team, I again want to say many thanks for your participation today and for the questions. And then we'll have to say looking forward for the next session, which will be in January. Enjoy the upcoming holidays. Merry Christmas